Right, so we have John and Jane Johnson as a case study that we're going to be looking at today when we're looking at what exactly you need to be considering for a comprehensive retirement plan. So let's start from the very, very beginning. I've got a bunch of different tabs open here. We got the retirement planning tools on the left. We've got the case study information here in this box. And we've also got an appointment agenda that I will go through and have as a guideline for us as we're discussing these retirement plans for John and Jane today. So we're going to assume they're sitting across the table from me. This is a pretty standard conversation that happens inside of my office. So let's begin. We're going to consider John. He has a birthday on January 15th of 62. We're going to plan for him to make it to at least 90. We could change this to any age that we wanted to, whether it's 92, 95, 100, or if you don't have longevity and you want to consider only 85. Just know that for simulation's sake, the tools are going to only consider you, they're going to consider you dying at that age, if you will. So John is 61 today. Jane is 59. A little bit about these two. So John had reached out through our online portal or on our online website asking for a conversation with an advisor like myself. He is ultimately wanting to figure out when he can retire, is what he's wanting to try to figure out. So they both live in St. Louis, Missouri. They do have a couple of kids, Tim and Sarah. I do not have them included on this plan here. If they had an upcoming wedding or grandchildren that they wanted to spend money on, I'll get to that here in a minute. We can add those individuals into this tab, if you will. So we can add a child, again, Tim or Sarah in this case. So I'm going to delete this child for now, but that's going to be the first tab that we're looking at. It's John and Jane, keeping it simple. Then we're going to look at what do John and Jane have as current expenses today. So we can talk about taxes. Everybody's got those. Their pre-retirement living expenses. This is a budget sheet that I tend to go through with clients where we're going to talk about everything. We're not going to include mortgage or debt or insurance payments inside of these boxes, but we can customize these being tailored to whatever your unique situation is. I know a lot of the times I've got pets that I fill in here in a couple of extra boxes. So we would get this information pre-filled prior to a conversation. But John and Jane, they spend money on gas and the occasional oil change and tire rotations every so often. We budgeted about $6,000 a year for that, or $500 a month if you wanted to break it down monthly. They have bills and utilities at their residence, their water, sewer, trash, electric, et cetera, et cetera. Jane, she does like philanthropy and she does like giving to charity. So she does incorporate that into their current living expenses today. They do go out to eat and they do use DoorDash as well, like what we all do nowadays. For entertainment, they do go to the bowling alley or the skating ring, or John actually in this instance likes to golf. He's got a little bit of a Harley Davidson hobby that he likes to get himself involved in. So he's got a little bit of a budget of some spending money there. Some fees and charges. We're talking about Netflix, Amazon, Hulu, all of these subscription plans that you've got going on. They've got a couple $100 tied up in those types of things. For gifts, they're going to be giving money to their kids for Christmas and their grandchildren. They've got an expected grandchild coming this upcoming winter from Sarah. So they do have a budget for that currently in their day-to-day living expenses. Miscellaneous, this is going to be more or less anything else that we're not covering. Same thing as this uncategorized area. So again, if you've got pets or some other unique line item that you'd want to add in here, we could go through that. They do have to shop occasionally. They got to replace those underwear and socks from time to time. And then lastly, they do a little bit of travel currently. So they spend about $6,200 after tax is what they need to take home collectively between their jobs in order to have the current lifestyle of what they want. So those are a couple of the two biggest expenses that we'll talk about in most cases. For John and Jane, they also are savers because they're thinking about their future. John has a 401k at his employer. He is actually employed at a factory in St. Louis. His wife, Jane, is going to be employed at a local pediatric office. She's got a 403b offered through that institution, and he's got a 401k offered through his institution. The employers are matching money. So on the first $3 or 3% of John's income that he puts into his retirement account, the employer is going to give free money to John in the same type of retirement account. So he's definitely taking advantage of that. Jane has the same situation going on inside of her account. You can customize these if there are any individual tiers that are going to need to be represented on these savings match opportunities. It's not always 100% dollar for dollar. Some employers may do 50 cents on the dollar, for example. They also both have a couple of Roth IRAs. John puts $300 a month into his. Jane also puts $100 a month into her Roth IRA. They also have a health savings account. I've talked about this in a couple other videos in the past, but the short version is you can leverage a health savings account to also supercharge your retirement income stream for yourself in the future for extra tax-free dollars, especially when that good old Medicare, those days start rolling around. So that's an item to note for a future conversation. For income's sake, let's talk about their situation. Again, John works for that local factory. He makes 100 or 110 grand a year. I need to update a couple of these numbers on my case studies. Jane, she makes 80,000 a year is what we've got her listed as. She does enjoy what she does, so she would work longer if she had to, but that's just a side note for future reference for us. We're going to assume for at least the time being that Social Security is going to be paying out. Now, we can make adjustments on this. For estimation's sake, it'll take what your salary is and it will make assumptions based off of your last 35 years worth of income or your last average 40 quarters on determining your Social Security. But I always suggest getting a Social Security statement for this exact input so we can actually use a real Social Security statement value inside of here for determining whether it makes sense to pull it at 62 or 65 or 67, etc. On to the next. John is also expecting an inheritance from his family. We know in his case, he's got a life insurance policy that's going to pay out tax-free to him. So that's pretty black and white. We also did not include any properties or vehicles or any of those assets that would be liquidated that would then be given to John in the future because we don't tend to bank on those. But in this case, we wanted to mark down that he's going to have at least a life insurance inheritance that is going to be headed his way upon his parents' passing. In this case, his parents are in their middle 80s, give or take. So we're being optimistic they make it to 2030. And then at that point, they'll have an injection of money coming into this plan. I also put a couple of little cards inside of here for if either of them would consider working until 67 if they wanted to defer their Social Security until those dates to give us a little bit of gap income between the period of retirement and 67, for example, here. Next thing we would talk about, this is the fun page. We would talk about their goals. So their initial goals when they got in touch with my office was that John and Jane wanted to retire at 65 and 63. They wanted a retirement expense income of $4,500 a month. We just used a simple approach because on the previous screens, they had travel incorporated into their current expenses. If you saw this $1,000 down here, so that would put them at $5,200 a year as their current living expenses. They could expect that they could cut back a little bit of their expenses, whether it's we know that the national average for a retiree's annual health insurance cost, today's numbers, is going to be $61 annually, so a little over $500 a month. That's between somebody's Medicare out of pocket and doctor's visits and prescription drugs and everything else in between. This number is going to get updated every year based off of healthcare inflation, which we estimate to run at about 5% on our end, at least in our assumptions. Fun fact, inside of this tool for all of these goals that we're looking at, I always suggest clients think about today's dollars because they do not have to reverse engineer and figure out what is the value of a vehicle going to be 15 years from now down the road. Because what we do inside of this tool is we incorporate on the back end inflation. So we'll be able to talk in future dollars after we've built out the plan in today's dollars. We've got a budget for long-term care. 7 out of 10 individuals over the age of 65 will need long-term care at some point. So we wanted to have a budget for that for them. This is what the annual expected cost should represent today for long-term care. This is in the national average for in-home care. This is not going to be like nursing home care. That would be closer to $108,000 a year. We just wanted assistance for in-home care in the event they needed it in the future. Next goal, there's the vacation goal I alluded to. So they want an annual budget from the date of retirement until the age of 75. They want to spend about $20,000 a year on traveling because they want to get as much of that in as they can because that's important to them. They also want to have the budget to give themselves vehicle upgrades every 6 years is what they determined prior to me building out this plan for them. John's going to buy himself a new to him vehicle at the age of retirement. So whatever that may be, whether it's 63, 65, 67, once we get on the upcoming screens, I'll be able to give them a better direction on what's going to make the most sense. But again, he's going to do that every 6 years. I put in $35,000 in here as a lump sum buying the vehicle. You would treat this as you are trading in your currently paid off vehicle. And in this case, John and Jane are officially debt free aside from their mortgage. They would, if he's got a $40,000 truck, for example, if he traded in that $40,000 truck and then added $35,000 to it, he's going to have a $75,000 vehicle at the date of purchase in the future with inflation built into it. So it's probably going to be $80,000 or something closer to that number once we get further on down the road. So I wanted to make sure I articulated how these would work. We could illustrate you financing these, which is always interesting depending on what the interest rates are, or you leasing them too. So fun fact. Other things that they have on their list. So John also has a Harley. A lot of my clients have motorcycles, ironically, so I wanted to include this in here. He wants to have an annual budget of about $2,000 a year to go ahead and do some modifications and improvements to his toy, because he tends to take it to some bike shows throughout the year currently, and he wants to be able to continue to do that into the future. Jane's also big into charity or philanthropy, so she wants to have the budget to more or less give away $250 a month or $3,000 a year for the rest of her life. That's a very important goal to her, so I wanted to point out that we can adjust these goals based off of how long you want them to continue. They don't have to just be a lifelong goal. In her case, she wants to give the charity until the end. But in the event of the Harley-Davidson improvements, for example, John's not planning on doing that until the day he dies. He figures he'll probably cut it back about closer to age 75, for example here. John also is a golfer. I have to admit I'm a golfer too, so I wanted to include this budget in here. He wants to be able to buy himself a new set of clubs every couple of years, so we've got a budget in that for that. He also wants to do a little bit of traveling with his buddies, so that would also include a little bit of a budget inside of there as well. Next thing we would do, since they have that new grandchild expecting in this upcoming winter, when they are retired, they also want to have incorporated a grandchild budget. They have budgeted about $5,000 a year, of whether that was just the extra monies they would be spending on the extra travel required, or plane tickets, or birthday gifts, Christmas gifts, to setting up college education savings plans or Roth IRAs for that grandchild. They wanted the flexibility to do a lot of things for that family member. They also anticipate on downsizing their home at age 75 in their unique case. So what they would do is they would sell off their home that they're currently living in, which we'll see on the net worth page, but it is a bigger home. We have it listed as $550,000, whereas the home that they want to downsize to would be closer to $400,000. It's a single level home. I also like to note inside of here, whenever you're budgeting for a home, you got to remember that you'll always have your annual property taxes, you'll have your annual insurance on the place, and you'll also want to budget for annual maintenance as well. I like to use a 1% rule of thumb in this case for anybody who's got home ownership going on. For the downsizing, why it gives me the opportunity to change the down payment is, hypothetically, you could take the equity from the home that you're in and invest it instead of putting it towards the equity in the new home that they're downsizing into. But in this case, they're just going to go ahead and get all of that money into the new home so they don't have a mortgage payment throughout their retirement years. And again, they're going to sell off their current home that they're in at the date of purchase, which is in this case is going to be 2037. That's the date that John is going to be turning 75. Lastly, they also have a legacy goal. So in addition to their home and their cars and their golf clubs and their jewelry and whatever else they have accumulated whenever they both pass, they also want to leave behind some money to their kids in the future. They want to leave behind at least $500,000 to each child, cash in the bank, if you will, or investments. Either or, they're equal in this scenario planning tool. But they want to leave that in addition to their homes and everything else that they have that's important to them as well. So those are a whole lot of goals that we've gone through on this page. Now we've got to look at what they're working with. John and Jane they've got a decent net worth they've been working on for quite a while now. They've got joint checking account and savings accounts. Jane's also inherited some money from her mother. I didn't mention that whenever I talked about John's inheritance that he expects in the future. Jane's parents are already gone in this case. So she has some CDs that she had bought with a recent she bought some CDs with a recent inheritance that she received from her parents in the total of approximately $200,000 that's in their name today. Again, they've got a joint checking and savings account. They do not have any credit cards. I could also add those credit cards inside of here if we wanted to, but the really neat thing about this particular tool is you can actually link all of your outside investments. So for example, I just manually plugged in that they had a 401k and it's invested in XYZ dollars, etc. But let's say they had a Fidelity account and they wanted to link it to where somebody could see the real-time investments and give investment advice on that in addition to the retirement plan. I always strongly suggest linking the retirement planning tools to your 401k. It does not allow access for an advisor to make any trades inside your 401k. It would just let them see what you have going on so they can make sure they're not replicating the same investments inside of your account with them. Whereas what you've got over in the 401k, you might want to just leverage the best investments options available inside of those accounts. But in this case, they don't have any credit cards, so we're going to get this off of here. Investment-wise, I've got this broken down over here on their net worth tab, but they've got John's got a 401k, he's got $600,000 in it. Jane's got a 403b is what I should have labeled this as, and she's got $350 in it, give or take. The Roth IRA for John's got $130 in his, Jane's got $85 in hers. They've also got that health savings account that I alluded to earlier, as you can leverage for taking tax-free distributions for your future healthcare needs, again, when you turn 65, or even qualified long-term care policies in some unique cases. So there's a lot of things you can do with these. John's investment account, I don't have anything extra over here. I just added it in case we decided we needed to save any more based on all the goals that we talked about earlier. So we've got all those investments. We've got the cash and the money in the bank. We've got a loan. That's going to be that mortgage I alluded to earlier. They only needed to take out a mortgage for $300,000 on that residence when they refinanced it back in 2020. They did it for a 15-year note and they locked in 4% interest rate. This is what they owe on it currently. This is what their monthly payment is. They're not going to pay it off early at this point, but we have the option to where we can make the amortization of the payments that they would be making fall by retirement or by age 70 or whatever it may be in their case. They're going to be linking this mortgage to the primary residence, which I told you guys earlier is a $550,000 home. We assume that, again, the property taxes are about 1%. We would get the real-time numbers on these. Annual insurance probably running at about 1%, maybe a little bit less at that price range, depending on the numbers you're running with different carriers. And then annual maintenance, I always like to have a budget for that as well. For insurance sake, so they do have group insurance for life insurance at work offered by the employer for one of their base levels of salary. So in John's case, it's going to be $110,000, and in Jane's case, it's going to be $80,000, for example. I need to update these numbers here on these plans as we're working on them. We've also got homeowners insurance with company XYZ. They think the rebuild value is going to be $900,000 on that home if they needed to build it from the ground up, assuming a tornado came through and took it out or whatever it may be. They also have joint auto insurance. I say that because they've got them on the same policies with each other. Item to note, they've only got $50,000 liability for bodily injuries and for property damages, and for collective injuries in an accident, only $100,000. That's actually a big no I would suggest for them. They're probably going to want to get an umbrella policy for maybe $2 million because they want to protect their assets in the event they had an auto accident, for example. You could save a ton of money on actually adjusting their deductibles. In this case, you could adjust their deductibles up to $500 and probably pay for the difference in the liability coverage on these policies. So I tend to suggest that being something that you look at very closely inside of your retirement plans too, because not only are you going to have to pay these premiums for the rest of your life, if you can save yourself a couple $100 today, if you amortize that over 30 years, that's going to start adding up over the long haul. So if there's any way to save on your auto and home and premiums, I always suggest you do that, but you also got to make sure you're protecting your assets as well. Lastly, I've got the vehicles plugged in here for a part of the net worth. So John's got a truck, Jane's got an SUV. We've got cost basis in here in case they decide to sell the vehicles and they had a profit, or if they wanted to claim some losses, if you will, against their taxes, depending on their situation. But we would include all of this information inside the plan to come up with their net worth number. So after this first big input phase, and this is a phase that normally takes a couple of hours, honestly, to go through top to bottom, just start talking about goals and assets and looking at all the nooks and crannies of somebody's financial plans. I've got a to-do list that I tend to send over pre-appointment so everybody's aware of these, but again, we've hit these from top to bottom. How long do you plan on living? Where do you plan on living at? They're going to live in St. Louis. They don't plan on moving because their kids live in, I think, in Michigan in this case, and then also in Texas in the other case, so they like being in the center ground of them. Where do they work? What do they do? Social securities, inheritances. What are your future expenses going to be in the future? Other topics that they were not interested in, they could talk to me about anything from gifting money to kids. Some people like to, instead of leaving a chunk of money behind when they die, they like to give the money to kids while they're alive so they can start to enjoy that inheritance with them while they're here on this planet. If you needed a budget for paying for a wedding. In this case, Sarah was already married, but in the event that she was not, then maybe they needed a budget for a wedding for her. If they wanted to purchase any land or property or rental properties, there's income producing properties and aspects inside of here where you can budget out for what a rental property would be able to provide you, including the rental income and the expenses and the taxes and the appreciation of the property and the loans against it and everything else in between. Home improvements, that's always a fun one too. If you were going to do a $20,000 renovation to your kitchen and it was going to increase the value of your home by $30,000, we can illustrate the arbitrage that happens or the gain that you have inside of that from adding the value to your home, which is going to affect you, especially in the future. If you decided to downgrade or move from one state to another, you're going to have to consider the value of your home today and what it would be in the future versus what the future value of that hopeful dream home or downsize or whatever it may be that's important to you as a part of as well. We could also go over purchasing and selling businesses. I will have to create a unique case study for that one. I've actually got a couple, but I need to polish it up and go through it a little bit further. But you can sell your business to your employees. There's a lot of unique ways where you can illustrate those types of scenarios inside of these planning software tools as well. What else do we have on this list that I didn't touch with you guys? Oh, are we on track to reach our financial goals? That is where we're going to pivot to. Once we've inputted all this information, we then get to go to our retirement button. This retirement button is going to tell us what is our likelihood of retiring based off of our current situation, our investments, and those goals that we just went over there. So their current situation, they are 69% likely to be able to retire the way that we just talked about, retiring at 65 and having money for retirement health insurance costs, for long-term care needs, for making it to age 90, for having a retirement monthly expense of $4,500 in their pocket every month to live on their living expenses, for the vacation goals we talked about. All those things from top to bottom. There is a little better than 2/3 chance that they're going to make it to the end without ever thinking about running out of money and having to make any adjustments to their lifestyle. Honestly, not a bad start at all. Optimal scores inside of this tool is going to be anywhere from 75% to 90%. 100% is actually a no-no inside of here because you're being way too conservative, meaning if John and Jane had a 100% and their goal is only to leave $1 million behind, they might be leaving $10 million behind on accident. They didn't mean to. So it's a balancing act of today versus tomorrow and figuring out what is most important to you and where you're going to focus your assets on, meaning retirement income or legacy or whatever of your other goals you may have that you discuss with somebody. But 69%, this is where we get to go in and make adjustments inside of here. But before I jump down here to start adjusting these numbers, because I do have a suggestion for them so you can see how it would look and feel real time. This is a screen that's going to show you where assets should be in the future. I could geek out on here all day. Honestly, I could spend 24 hours inside of this tool. There are so many different viewpoints and different perspectives that we can discuss and talk about inside of here. But I like this one because it shows you what your expectation would be of at age 75 on average. It's going to go based off the first person. John's age 75 in this case. On average, they're still going to have about $2 million as part of their net worth as assets for themselves in the future by age 75 in the middle scenario. What I mean by middle scenario, this is a simulation that runs 1,000 different hypothetical scenarios at the snap of a finger every time we refresh this thing. So 690-ish of the scenarios, maybe 689 or 691. Again, they made it to age 90, both of them, and never ran out of money based on these goals below. The other 310 times, they ran out of money prior to dying, more or less. So in order to increase this likelihood of success up, we've got a couple different ways we can go. John's actually excited to get out of there maybe sooner versus later, so I wanted to show a couple scenarios how we can make that happen. So in the case or the suggestion that I was going to make for them, if John wanted to retire at 63 and Jane wanted to retire at the same time as him, if we wanted to make those adjustments and nothing more with their plans, they're going to have a shortfall over here. They're not going to be very likely to make it to the end without running out of money much quicker than they expected. So a couple suggestions here. I am first off going to show you guys an investment tab. I'm going to jump around a little bit. This is how their current investments look. They've got 53% stocks and 47% bonds for the super high level 10,000 foot view. We can get into the weeds about the different types of investments inside of there, but based on a risk tolerance quiz that they took with me during this conversation as well, we think their investments should be closer to 70% stocks and 30% bonds. What that's going to do is it's going to give them a higher standard average annual rate of return over the long haul, which is going to help them simulate better inside of these tools as well. So if I go back to this screen and I change their current allocation to a growth focus, which is what that 70-30 focus was, and they want to retire at 63 and 61, we should see this move on up a little bit. But let's see what happens. Yep, it jumped up a little bit to 36%. So now 1/3 of the time they can retire the way that they want to at age 63 and 61 with no adjustments whatsoever. So I did jump ahead and fool around with this to come up with a solution that would be suitable for them. So the first thing I would suggest if they wanted this would have been the investments, change the diversification to be a little bit more aggressive because they've shown that they are comfortable with that based on the risk assessment that, again, we completed. If they wanted to decrease their living expenses down to $4,200 a month versus $4,500, if they also wanted to give up a little bit of that vacation goal, just a little bit of it, 10% of it, because they retired 2 years earlier than they expected to, that would be one big adjustment they can make. I also was going to hint at them on saying, hey guys, I know kids and I know your kids are your kids and you love them to death, but which is more important, your retirement income or the inheritance you leave behind? In their case, the retirement income was more important. So we can make this a second fact or a factor that we can focus on in the future after we know that they're going to make it to the end. But let's just see how it looks with those couple adjustments. And lastly, if they wanted to retire early, I made a suggestion to them. I said, I'll make you a deal. If you retire early and you guys would consider getting part-time gigs, and in their situation, they could easily find something paying 15, 20 bucks an hour. Excuse me, that's if they wanted to work full-time. If they wanted to work part-time, they could easily find something making 30 grand a year doing contracting work or whatever it may be because of their work experiences that they have. So they thought that would be not a problem at all whatsoever, doing that from retirement to age 67 to fill in those gap years while they're not receiving Social Security, so they don't have to draw as much off of their assets inside of their accounts. So that was a suggestion to them as well. Lastly, if they wanted to go ahead and increase their Roth contributions and do $500 a month or $6,000 a year inside of those accounts, that's also going to give them more ammunition that they could have towards their savings that they could pull from in the future so they can not run out of money. So if they did all of those things, that would get us to a 79% likelihood of success, which in our world it's a check mark. You got it. You can pass with this grade, if you will. And that's what you're focused on. If you wanted to be more aggressive, the lower your score goes. So if you wanted to flirt with the 75 number, that would be the most aggressive retirement plan. The most conservative retirement plan would be like scoring a 90 or above inside of this. So if they said, you know what, Corey, we can live on only $4,000 a month, and we want all the other things to stay the same, that's going to push their comfort. That's going to push their likelihood of success up because they're not planning on spending that much money amortized over the rest of their life inside of the tool. So I wanted to give that reference point, or at least a suggestion on how some of these plans would work. This would be something that's done over, at least to get to this point, at least 2, maybe 3 appointments. So that is a time commitment that I know is required, but a lot of the legwork is done by myself and my staff on pre-filling a lot of this information in so we can be efficient with our time. Because the best part about all of this is there are so many different ways to slice and dice your information. So this 79%, let's say we're happy with it. I can go back to this confidence page and I can show you guys what you should expect to have in your retirement accounts by age 75 or any date in the future. This is one that I think is very powerful though. This is going to be projecting future dollars of what you expect to be pulling from your investment accounts or your other income sources in the future as well. So orange is going to represent what they're pulling from their investment accounts or their 401ks or their Roth IRAs. And we can get into the fine details of that and which accounts they would be pulling from for tax sake, because it's not what you make, it's what you keep. You want to make sure you're pulling from the right account types throughout your retirement years too, so you can minimize the taxes that you're taking on your distributions. So the first year of retirement, they're going to be pulling out 164 from their investment accounts. They're also going to be doing that part-time work. So if you remember, that was $30,000 they each were going to be making. We've got inflation in there a little bit over a couple of years. They would be making approximately $61,000. They would need 164 out of their accounts to supplement that lifestyle that we talked about. Because what are they doing that year? They're actually buying a couple of vehicles that year. That's where they're going to need a lot of the money from. And in their case, we didn't illustrate them financing it, although we could. The next year, they're still going to make about the same amount of income. We're assuming pay raises for cost of living adjustments. They're going to be making 63. They're only going to need 93,000 from their investment accounts that following year. Because again, the previous year, they both upgraded their vehicles, and they're going to do that every 7 years. So you'll notice there's going to be another uptick in this year when they're spending more money on vehicles. Now the blue is going to represent the Social Security. At this year, this is when John is getting his Social Security. He's pulling out $29,000 that first year is what we estimate based off of not having his actual Social Security statements. Again, I strongly advise somebody have those because you can get them from SSA.gov very easily. But after a couple of years, it's going to illustrate both of them pulling their full Social Security because they both reached the age of 67. So that's going to be where a portion of their income is coming from, and the rest of it's going to be drawdown from their investment accounts. You'll also notice what happens when they turn 75. They have a whole lot of extra income that year because what happened? They decided to downside their residence, so they're going to have a big injection of income into their plan. So we would plan this all the way out, and in the last years, it looks pretty crazy. Reason why this is those long-term care needs that we illustrated way back on those goals pages. So if you recall, it was like $59,000 a year for long-term care for in-home care for 2 years is what we expected, $59,000 per year. If you put inflation inside of there and we run it at 5% compounded over the years, that's where the prices get really big. This final year, it's going to be $1.2 million almost that we're going to have total cost for the entire plan. It makes everything balloon. But in their case, they're still okay. I would actually not tell them that they need to, in their unique situation, probably purchase a standalone long-term care policy because they have the assets to provide if they need it and they both go into the nursing home for 2 years. So I love talking about these retirement details, but there are so many different viewpoints that we can look at. If we're happy with that score of 79, we can put more or less this plan through a stress test, which is always very eye-opening, if you will. So the stress test tool, how it works, this baseline, again, we're happy with that 79 on the previous page. It's a 78.6, so we're close. So rounding error, if you will. But let's assume the stock market's dropped by 20% instantly. What would happen with the score if that was to happen tomorrow? The new plan score would be 63%. It wouldn't be a 78, and that's assuming all things the same. So it does show that market volatility is going to affect the likelihood of success inside of their accounts. That would be a conversation to discuss about risk tolerance, also a conversation to discuss on how much they wanted to have in the stock market versus in equities or annuities or other fixed income payments that are going to provide them less volatility over time. If taxes were going to be 20% higher than what we've illustrated, and we've got real world tax built into the backside of this, we've got the Tax Jobs and Cuts Act that Trump had in administration. That's going to sunset here in 2027. We've got this built out all the way through that as well. But if taxes are 20% higher than what we illustrated, then their score would drop to a 70%. Why does that matter? Is because they've got a bunch of money inside of those 401ks that they're going to be taking distributions from. So if they're going to be having to take more money out to net the same, then they're going to have less money that they can have sitting in there growing and working for itself for a future date. If Social Security is dropped by 20%, and this has actually been a reality that's been talked about on the news quite a bit, that Social Security is going to run out in the future. If there is a permanent reduction of Social Security benefits of 20%, in this case, again, their score is going to be a 61 point if they live 5 years longer than they meant to, which is a wonderful problem at the end of the day. But most people are worried about running out of money. They've still got a decent score. So longevity is not actually a weakness from my point of view on their retirement plans. Inflation could be. Inside of the tool, we run 3% inflation inside of here. If inflation ran at 4% annual compounded year over year, they would still 2/3 of the time be able to make it to the end. Healthcare, if their healthcare expenses were 20% higher than we anticipated because they had really bad health problems going on or whatever it may be, they would still be at a 70%. And then lastly, if the assets didn't perform at the levels illustrated inside the tool. So I told you guys earlier, the average rate of return of that growth portfolio was going to be 8.8% over time. So and this is a descending scale as well on the risk. So let me go back and talk about that briefly. So on the action items, the glide path, that's what I was referring to. The glide path is going to show you taking less and less risk the longer you are in this plan. So the older you get, the less risk you take is the short answer to that. But if investments perform at, again, 1% less year over year compounded over the rest of your life, you would still 60% of the time be able to make it to the end without running out of money. So I like to show people this page because it shows them all of the weaknesses or the pain points that we can talk about to see if there's any ways that we can make adjustments to improve these scores together as a team. So I like to show that tab. For insurance sake, this is going to show if they were happy with that 79 score. This is going to show if they need any life insurance on themselves. And in their unique case, they actually don't. They've got their term insurance or group term insurance at their employers on their lives, but assuming one of them died today, the other is going to be okay and could probably even retire sooner. I say that because your average reduction in living expenses for someone who is wanting to retire and loses a spouse is going to drop by about 30%. So all of those goals that we talked about, a lot of them are going to be gone too, because John wouldn't be here to spend all the extra money on the golf equipment or on the Harley expenses that he wanted to incorporate. The travel budget probably wouldn't be as big because there isn't two people that you're needing to buy plane tickets for or pay for food and meals and everything else in between. So in their case, they actually don't need life insurance, which is interesting. We can also talk about their estate situation. Do they have any wills or trust or powers of attorney or healthcare proxies, and making sure their beneficiaries are all going to be set appropriately on inside of their accounts. And then talk about if a trust is reasonable too. In their case, they've got a couple $1 million. It's probably going to be a conversation that's had talking about the differences between a trust and a will and the advantages and disadvantages of both. Taxes are going to be another thing that we talk about too. Again, I know I'm jumping all over the place. There are just so many things that I can pack into here that I love to geek out on, just depending on who wants to talk and what we want to talk about. But again, it's not what you make, it's what you keep. So here's what we project tax brackets to be for this couple in the future and where they're going to be at overall. Here's the fine details. We can almost even file our tax return. That's probably something I'll be doing in the future, but right now we can make some very good guesstimates and pre-fill a lot of their forms if they needed any help with those. That is a quick recap on what to expect for a first appointment or a financial planning building appointment. Why I wanted to put together this video was that I'm going to be actually offering 5 free financial plans. These are things that I normally charge anywhere from $1,000 on up, depending on who you talk to and how robust your plan is. I wanted to go ahead and build a virtual presence online and offer 5 of these to the first 5 individuals that decide to sign up. I will put my contact information in the description of this video if you'd like to talk about these further. Ideal clients for somebody we are interested in working with would be somebody who's going to let us see everything. Why I say that is because all of these retirement income plan topics are all going to be intertwined with one another. For example, I mentioned earlier the home and auto insurance. That may not seem like a big piece of somebody's puzzle, but I can build a awesome retirement plan for somebody. And then if they get themselves in an auto accident and hurt somebody, that can completely wipe away everything we've been working together on just from not making the extra 5 minutes of grabbing that paperwork for a quick review while we're going ahead and working on this stuff. I also like to take a look at any type of insurance policies you have going on, whether it's your current group employer plans. You might be leaving money on the table that you didn't know about. You might be able to purchase life insurance through there for very cheap versus a life insurance agency like myself or somebody else out there that's going to cost you maybe more. I don't know. You could be looking at the disability policies inside of there and also the accidental death and dismemberment policies. You can make yourself an expectation for what it may cost you if you decided to retire before 65 and before Medicare kicks in. Your COBRA insurance is going to be probably costing you twice as much as what you're paying now if you decided to retire prior to 65. So those are all variables that are very useful to put inside of these tools and illustrate out so you can actually have a real world idea of how retirement could look for you. On top of that, tax planning, we talk about a lot of different topics inside of the tool on that, but just looking at, again, I could talk about the group health benefits. If you have an HSA eligible inside of your group health insurance plan, so important. Like, you have to be looking at those as a consideration, not only for today, but the future you. Tax, and for John and Jane, in this case, there was not a lot of talk again around the account types that they're considering, but another suggestion I would probably be making to John and Jane would be, hey guys, if you actually do want to retire before the age of 65, let's talk about Roth IRAs a little bit more, because there is some Affordable Care Act Obamacare insurance that if you wanted to retire at 63, John, and 61, Jane, we actually need to maneuver your income to where we make it look like you make less so you can have a lower health insurance premium or a bigger tax credit on those subsidies out there. There are so many different ways to slice and dice your information that I just love to gobble it all at once so you can take like a 10,000 foot view of everything and then start working on each piece of the puzzle to make sure it's all comprehensive and holistic and going to be the best bang for your buck for the time and effort and energy that you're putting into it. Lastly, what else do I got on here on this agenda that I tend to bring out with everybody? Oh, outside accounts and stuff for investment management. Your investments tend to fall in place immediately after your financial plans fall in place. I say that because there is a risk assessment that I go through with most of these clients, actually all clients if they have investments with me, for example, but I'll just bring one of those up so you can see what it looks like. So this risk assessment is going to be done on this screen so you guys can see my face because I think we lost you. I guess I don't know where I went. But this risk assessment, we're going to go through it real quick. We're going to get started. This is for John Johnson. Don't have his email. John Johnson. Okay, we've got that. What is his goal? His goal is retirement, wealth accumulate. We're going to expand the screen a little bit. We've already talked about the comments in their financial plans that are important to them. What's their investment amount? If my memory serves me right, they've got approximately this much in their investments. John's birthday is 1/15 of 19. Retirement age goal, I think we discussed it earlier. We're going to leave it at 63 for now. So how does John feel about the market? He was overly positive about the market. He is very confident about his financial future as well. He again wanted to come talk to an advisor to learn how he could better set himself up for the future. So risk and reward, they go hand in hand. So that $1.1 million, this is a sliding scale that's going to give us a feel for how much up and down he could tolerate or they could tolerate with their investments. If we slide this all the way over to the right, they're 6 months from now, they could make as much as $346,000 or they could lose as much as $234,000. That's their range of returns within the next 6 months. Very important to know. If they were like, yeah, that's outside of my comfort zone, and they wanted to go all the way down here, they're saying, you know what, Corey, I'd be very happy if I made that much in 6 months. I wouldn't lose a bunch of sleep if I lost that much in 6 months, but I've got a little bit more wiggle room. So maybe I want to go right in the middle, or maybe a little bit on the high side. Maybe I would be very happy if we had this day. I'd be unhappy if we had this day, but I could stomach it because I know that I could work longer if I had to and if it was necessary. So this is the score we're going to go with on their hypothetical assessment right now. So then I'd ask them, okay, what if the stock market dropped and your accounts dropped this quickly? They're saying, well, I know I got to continue to work, so I'd stay invested. So that's how they would answer. Then we get to put their comfort level to the test. We get to tell them, okay, we're going to present options A and B. Option A would mean that you can take those range of returns that we just showed that you chose on the previous screen, or if somebody walked up to you and said, hey, 6 months from now, I will pay you exactly $30,000 if you put this in a fixed rate of return. Which would you choose? John and Jane, they chose option A because they know the range of returns. That's something they would rather have versus a fixed rate of return at the current moment in time. Then they were asked the same question again. Would you take the same range of returns? Or somebody now walks up and says, I'll double it. I'll pay you $60,000 if you decide to go with the fixed rate investments. That caught their attention. They decided to still leave it invested, but if it came back higher, then they would maybe consider doing a fixed rate of return, which it did in the next question. In the event that they were presented an option of investing and making either this much or losing this much or falling somewhere in between versus making a guaranteed $76,000 in 6 months from now, they would take the guaranteed return. Then the same question is asked again. They would look at options A or B. Option B dropped a little bit. It was still higher than the $60,000 that they said that if they got offered more than that, they would go ahead and take the fixed rate of return. So they went ahead and chose this option. All right, last question. Ranges of returns widened on their investments. They could either make more or lose more based on the ranges they told me that they were comfortable with, or they could take the guaranteed rate of return of exactly what it was in the previous question. They said in this case, they would take the previous rate of return. So this will spit out a risk number. It's going to go from 0 to 100. In their case, they scored a 61. So that is what I have inputted on this scoreboard over here inside of these retirement plans. That is how we got to the conclusion of John and Jane having a 79% likelihood of success inside of these reports. So I hope this plan building was useful and it set an expectation of what you can expect whenever you're talking with a financial advisor, especially myself inside of my office. This is what I love to work with people on. This is what most people come to me for. So if you'd be interested in a conversation, I would love an opportunity to do, but please make sure that if you are not going to be talking to me, that you consider all of this as a suggestion for you to talk to your current financial advisor about, your tax advisor, your attorney, whomever it is that you handle your financial consulting affairs with. I just wanted to show you my version of how I think a financial plan should be built and what I think you should be taking into consideration when you're working on yours. So thank you for spending your time with me today. Hope you have a good one. Talk to you soon.